So we will be looking at the case study Mount with the next slides. The facts and circumstances are on slide 171. And well, we will look first at the 5 workings for this case study. We already, we will do it for the under case of a fair value valuation of the NCI based on the method that we take information from the market, from a stock exchange. And then with the second one, we will do this if those market information is not there, or we decide not to take those market information and calculate the fair value of the non-controlling interests on the proportion of net assets. So we will use these 2 methods to come up with the consolidation table. All right, so first we would determine the group structure, which is 60-40 for Mount and Everest, as you can see on this solution slide. As always, you will get that at the end of the session. I will upload these solutions to the e-learning platform. So that was simple. We will now calculate the NCI at acquisition. So NCI is 40%, as we can see here. The number of shares, of total shares, were 200 million, and the market value per share was 5. So the fair value of net non-controlling interest at acquisition is 400 million. 200 times 5 times 40%. So that's clear then. We then can calculate the full goodwill because we base this valuation of NCI on fair value. Therefore, we will take also a fair share of goodwill from that information for the non-controlling interest. We will calculate that. Fair value of the parent's investment, which is the purchase price, was 900. So 900 for 60%. We have to add the other 40% to represent the total value for both shareholder groups, the parent, which is controlling the group, and of course those shareholders which are not part of the group, but they have a share in one or more subsidiaries. So in this case, in one subsidiary, in the fair share of 40% in Everest. So that is 400 million, those that we just calculated. And then we are able to subtract 100% of the net assets valued at fair value from that value that represents the fair value of that investment, if it would be a total investment. So we have a full goodwill at acquisition of 500, well, 500 represents not only the parent's goodwill, it also represents the goodwill that is related to the non-controlling interest, and therefore we will show a full goodwill at acquisition of 500. So less impairment, well, there was an impairment of 100. So the total full goodwill at year end will only be 400. I think that is clear. Whenever you have a question, please don't hesitate to put it in chat or open the microphone. But please, not all at the same time. I have to handle that. All right, so then we're able to calculate NCI at year end. Well, at acquisition, we know it was 400. So that is the starting point for the valuation of the non-controlling interest at acquisition. So they have also a share in the profit. So in the facts and circumstances, it said that there is a post-acquisition profit, or we could guess that from the information that net assets had risen from 800 to 950. So the difference of 150 must be profit. And the share of NCI is 40%. So they will get 40% of the 150, which is 60 million. So we will add that to the starting point, the 400 million plus 60 million. And then, of course, as we have full goodwill, the non-controlling interest will share part of the impairment loss. So minus 40% of 100. And then we can calculate the fair value at the end of the year, which is the reporting date, 420 million. All right, so then we look at the group. The other shareholder group, which is in retained earnings. So we start with the parents' retained earnings of last year. That is 500. The parents also have a share in the post-acquisition profit, which is 60%, not 40%, but 60% of those 150. So that would be 990. So 90 plus 60 equals the 150 profit. So profit is distributed to both shareholder groups, the NCI and the parents. And then the parents have to share this time 60% in the impairment loss, because the full goodwill will be related to parents and NCI. So the total retained earnings of the shareholders, of the parents' shareholders, which is the same as the retained earnings of the group, is 530. Okay, is that clear? Yeah, good. Then we will input those data into the consolidation table. But before we do that, we just calculate the same or similar values for the case when we use the proportionate method. So same structure, no difference. We have the calculation of the non-controlling interest at acquisition. That is 40% of the net assets of the subsidiary at acquisition. So that is the number that we have figured out when we did our purchase price allocation. So net assets were 800, and the fair share of this of the NCIs is 40. So 40 times 800 equals 320 million net non-controlling assets at acquisition date when we use the proportionate method to value NCI. Okay, then we can go on with calculating the goodwill. Parents' investment is the same, 900, plus the fair value of the non-controlling interest at acquisition, which we have just calculated. So we have the 900 million purchase price for 60%, and the fair value for the other 40% of the two shareholder groups. So they have a fair value of 1,220. And then we can subtract 100% of the net assets, which is 800 million in this case, same as here. So we have the goodwill at acquisition of 420. Now here the problem is that we don't have something in relation to the non-controlling interest. We don't know what they would have paid if they had to pay it once again. So there is no goodwill, no additional purchase price, no premium that we could add on these 320 million to come up with a full goodwill, right? So when we go back we see that the fair value of NCI, when we take the fair value method, is higher because the stock price includes a premium also for the non-controlling interests. It is the same fair value for all shareholders, whether they are majority shareholders or minority shareholders. There is only one market price. But when we look at the proportionate method, then we only have a market value for the parents of 900. We don't have a market value for the non-controlling shareholders. And that is why we would only allocate the goodwill, which we now calculate, to the parent, because we have no such information for the non-controlling shareholders. All right, so we have the total fair value. We subtract the net assets of the subsidiary, and we come to a goodwill at acquisition of 420, which is, of course, lower than as if we had used the fair value method. So less impairment, that's the same thing. So the goodwill at year end will be 320. Now, goodwill is clear, then we can calculate the NCI at year end. We will start with the fair value at acquisition, which we have calculated in our second working, and then add the share of the post-acquisition profit, that is the same thing, so no difference, of 60 million. But now, as we are in the proportionate method, we will not include a share of the impairment loss of the goodwill, because the goodwill only relates to the parent. So, of course, the non-controlling interest will not share in that impairment, because the goodwill is only related to the parent shareholder. So that is a big difference in that method, and we just subtract 0. And the fair value of NCI is 380 at year end. And that will be the number that will be shown in the consolidated financial statements. Well, and then we will calculate retained earnings of the group. We have a starting point, which is the parents' retained earnings from their single financial statements number 1. We add any post-acquisition profit to this starting point, and the post-acquisition profits are 60% of 150. So the 40% went to the NCI and 60% to the shareholders of the parent. So that increases the retained earnings of the parents of 500 to 590. And then we deduct, unfortunately, 100% of the impairment loss, because, you know, the goodwill is only related to the parent. I told that many times. So in that case, only the impairment loss is only allocated to the parents' retained earnings, which are the retained earnings of the group. So 490 million. So now we can put those numbers into the consolidation table, and we can do so with on a first step for the fair value basis and the proportionate basis, because these steps are the same. I will not use two forms because they basically have the same numbers. So the solution is for both methods the same. So what we would do, we would just well, have the capital consolidation for the parent Mount and the subsidiary Everest in the single financial statement of the parent, we see the investment of 900, which is the purchase price. And in Everest, the subsidiary, we will see the equity of 950 of net assets. So that is the starting point. And well, then when we do the capital consolidation on the fair value basis now, we would just have to add the numbers here. So which is this subtotal over here. So we would take that and now make our consolidation entries. So the first thing is that we will eliminate the 900 and put or show an investment of 0 in the financial statements. Then we will put a full goodwill of 500 at acquisition into the consolidation entries. So 500 relates of those 900 relate to goodwill, and the 100 represents the impairment loss of 100 at the year end. So we will show a goodwill for the group of 400, and this is, maybe you can change that name here, the goodwill, or well, basically on the balance sheet, it will show a goodwill, but we know it's a full goodwill. So maybe you put some remark to that and say in brackets, this is a full goodwill. And what else do we do? Well, we will get rid of the equity of the subsidiary, which is 200 and 750, which you can see here. So credit of 900, a debit of 200 and 750. So we have some non-controlling interests to show into the group account. So that is the fair value at acquisition of 400 plus the share in profits of 60, less a share in the impairment of 40. So at the end, the non-controlling interest is 420. And the retained earnings of the group will get a share in profits of 90, less a share in impairment loss of 60. So we would increase retained earnings by 30. So in the end, you will see retained earnings of 530. You will have a non-controlling interest of 420. Well, current liabilities is easy. 5 plus 3 is 800. 600 plus 1 is 700. What about tangibles? Well, 400 plus 500 is 900. No investment, that's good. Inventories relate to 200 to the parent and 400 to the subsidiary, so 600. Receivables, 350, and cash at bank, 300. Yes, and when you sum up the totals, and I'm a friend of control totals, you know that already, as I'm an auditor. I'm always checking balances, whether I make a mistake or not. So we add all these assets and come up to a sum of assets of 2.550. And then, well, when we do the same for the equity and the liabilities, we also end up with 2.550. So that shows to me that at least I didn't make a mistake concerning the debits and credits. All right. So is that clear, or are there questions why I would use these kind of figures? All right, so if you have no questions, then I will go to the next method. So we will do the same, but the same as we have done when we valued the non-controlling interest on the fair value basis. We will do it now on the proportionate basis. And here you will see that the goodwill is a little bit lower because we calculated it to be 420 at acquisition date. And then, of course, this goodwill was also decreased by the impairment loss of 100. So the goodwill will be 300 at year end. But the difference now is that the parent will share the profit of 90, so that's 60% of 150, less the 100% of the impairment loss, because now we are on a proportionate basis where we valued NCI on a proportionate basis. We will allocate the goodwill only to the parent, and any impairment, of course, will only go to the retained earnings of the parent. It will not affect the NCI's valuation. All right, so we have the share, the parent gets plus 500, sorry, plus 900 and minus 100. So the minus 10 is a credit or a plus in credits here. So retained earnings will increase, will decrease by 10. So in the end, they start with 500 retained earnings. And then they will have plus 90 minus 100. So the retained earnings of the group or of the shareholders of the parent is 490. Okay. What else is to say? Well, we talked about goodwill. We talked about the retained earnings of the parent. And well, we have to look at the NCI. At acquisition, the value, the fair value of NCI was 320. So that was 40% of net assets, plus the share in profits, which is 40% of 150, that equals 60. But there is no share in the impairment because we are valuing the NCI on a proportionate basis of net assets. And therefore, the goodwill will only be related to the parent. Ooh. Is that clear? Well, I hope so. All right, so what are the key messages of my example? Well, the valuation and the characteristics of goodwill depend on the methods used or on the method used. So either we take the fair value method or we will use the proportionate method. By the way, you will find this information in the financial statements when they will talk to us about the goodwill, how they would calculate that. So which method will be used? Well, IFRS tells us, well, that's an accounting policy decision. You may use either one, and you can do that for all of your subsidiaries individually. So that must be determined at acquisition date. So you can either choose the fair value or the proportionate method. It does not depend on the fact whether there are fair values available for the subsidiary. So if that subsidiary is listed at a stock exchange, of course you have fair values then, and maybe you could also value your subsidiary at discounted cash flows. So you would also come up with a fair value for the whole company. So if you are doing that, you would use the fair value method, and you would end up in a full goodwill. So if you don't want to use fair value information either from the stock exchange or from discounted cash flow models, then you will go into the proportionate method. Just look at net assets, which you have calculated at acquisition date, and then use the share of the non-controlling interest to come up with a value. So the difference is when we use the fair value method, the results will be full goodwill, parent and LCI. The inherent loss is split between those two shareholder groups. And when you are in the proportionate method, it will result in goodwill only that is related to the parent only, and therefore the impairment loss is attributed to the parent only. All right, so those were my key messages. And now we will look into debt consolidation. Debt consolidation is the second step in consolidation. And it deals with intercompany accounts. So there might be some transactions going on between a parent and a subsidiary, or a subsidiary and another subsidiary. So these transactions between group companies are called intercompany transactions. So when we are talking about intercompanies, then we mean that those are entities of a group. So intercompany accounts are transactions between group companies. So what are examples? For instance, products sold by the subsidiary to a parent. And of course, when they are paid at year end, we don't have a problem. We only have that problem when those transactions were not paid at the year end, because then we will show in the first case, when there is a product sold by the subsidiary will show a receivable from the parent, and the parent will show a liability to the subsidiary. Or same thing is when you have a loan that will be granted from the parent to the subsidiary, and the subsidiary has not yet paid back that loan. Well, then the parent will show a loan receivable in its financial assets, and the subsidiary will show a financial liability in their single financial statements. So when we have to consolidate those intercompany accounts, then we have to eliminate same items. So these intercompany accounts have to be eliminated, as they do not represent receivables from or liabilities to a third party. So remember, when we look at group accounts, we want to show the accounting as if this was only one, or the group was only one company. So when you have only one company, you would not show liabilities from your left pockets to the receivables of your right pockets, right? So this is why we would eliminate that. So let's assume that products have been sold by the subsidiary to a parent, and at year end, the parent has a receivable. So intercompany receivables. Products sold by a subsidiary to a parent. So the subsidiary will show a receivable, and the parent will show a liability. Okay. So in that case, we will have a subtotal in the when we add all these columns up, we will have an intercompany receivable and we will have an intercompany liability. So in practice, what we do is that we will show intercompany receivables or intercompany liabilities in the same row. So this minus would go up to this row, and then when doing the summing up, then there would be a subtotal of 0, right? But I mean, this is just one method of eliminating it. So many companies do that, put it in the same row, and then there is no subtotal. But if you have this kind of a presentation, then of course you will show receivables of the subsidiary and the liability of the parent. And then you have to manually make the consolidation entries. What you would do, you would debit the intercompany liability 600 and credit intercompany receivables by the same amount, and then it's correct in the group accounts. We do not show intercompany receivables, so receivables that relate to internal transactions, and we do not show intercompany liabilities. Okay, so that is, I think, very easy, clearly understandable, but there are some problems and we have to look into those. So what if, just imagine, what if the receivable is not the same amount as the liability? Well, you might say, well, how come? That cannot be possible. If you have a loan and then the one is receiving the loan, or he has a receivable, and the other one has a liability. So those must be the same amounts. But well, in practice, there are many cases where these two things do not match. So for instance, you have a loan from the parent to the subsidiary, and the subsidiary is having a rough time, maybe to Corona or whatsoever. So they really have problems in paying back that loan. And from a single financial statements point of view, the parent has, of course, to evaluate the possibility that they will not get back their receivable. So in the end, at year end, they have to argue with the auditor and say, well, we do not hope that our subsidiary will not pay back the loan, but at the moment it looks very, very bad about that subsidiary. They have tons of losses, and we don't think that they will be able to pay back the loan in the near future. So what will the auditor say? Well, from a perspective of the single financial statement of the parent, you have to write that loan down to the fair value of what you think you will get in the future. Okay. Same thing with a receivable that relates to deliveries. When the other group company cannot pay back that receivable, well, you have to consider a write-down. So with the receivable, you would write that down. What would you do with this, with the corresponding liability? Well, can the subsidiary say, oh, that's great. The receivable was written down by the parent, so we can also release our liability because we don't have to pay it. Well, that's not accounting, right? So you have to stay with your liabilities. You are not allowed to write them down. So that is why a receivable could be lower than a liability in the same group, and therefore a receivable might not match the corresponding amount of a liability. Well, that is when you write that down. Another reason could be when the parent has not received what a payment, not received. So for instance, you have an example here, the subsidiary paid their liability on the 30th of December, but well, at year end, at 31st of December, well, the payment was at the bank. Yeah, and the bank only transferred the money to the parent, to the parent on 3rd of January. So what happens is that the payment was in the so-called banking system at year end. So how does the financial statements of the subsidiary look like? Will they show a liability at year end? No, they will not show a liability because they already paid that. So they will show a liability of 0. What about the parent? They only received the transfer on 3rd of January, and therefore they will show a receivable at the year end. So you have another example from practice why a receivable is not equal a liability in a group, just because of what is it, a money in transfer issue. So it's a timing difference in accounting. Same thing can happen to goods. So goods not received. So the goods sent in 2 parcels before the year end, and only 1 parcel was received before year end by the other group company. So what the seller shows, they will show a receivable for 2 parcels, and the receiving group company will only show a liability for 1 parcel. And the other parcel is blown in the wind. It's goods in transit, what we call them. So that's another possibility where a receivable is not equal to a liability, although the transactions, when you look at it in the long run, are equal amounts. Yeah, and we just talked about the receivable impaired and the liability not adjusted. So basically those 3 reasons are the most you will find in practice when a receivable is not equal to a liability. Now, what can we do about it? And I think we just look at the facts and circumstances and do that together in class. We have the case study called Cash in Transit. The facts are a parent sold goods to a subsidiary and recorded trade receivables of 300. So in the parent's single financial statements, we see a receivable of 300 because they delivered the goods to the subsidiary. Well, the subsidiary recorded inventories of 300 and trade liabilities of 300. So what they did, the subsidiary showed inventory of 300 and they booked a corresponding intercompany liability of 300. But then shortly before year end, they transferred $50 to the parent. So the trade liabilities, they reduced from 300 to 250. We will not show for the other transactions to make it not unnecessarily complicated. So we just refer to what is here and not look at the balance of debits and credits. I know that this is a little bit complicated, but okay, I think that's for simplicity reasons, we just look at the final balance here. So in the end, the parent received the money on 3rd of January, which was debited to the parent's bank account by then. So at the year end, they still have an intercompany receivable of 300. And the subsidiary only shows 250. Now, what can we do? Well, we will make our normal procedures as adding up all subtotals. So we have inventory of 300, we have intercompany receivable of 300, we have cash, we have, well, in this case, 0, and intercompany liabilities of 250. Now, well, we have the problem. We have to eliminate the intercompany receivables. So we put a minus here to eliminate the intercompany receivables. So in the end, in the group accounts, we will not show any receivables that are within the group, left pocket, right pocket, how I call it. And we will just debit the intercompany liabilities, but we cannot do that. We cannot debit that by 300 because then we would show a receivable of 50 here, which would not also not be right. So we can only eliminate what is there. So the debit will be 250. And then we have a difference of 50. So what do we do with that difference? Well, you know that the bank paid 3 days after the balance sheet date, paid that cash to the parent. So obviously, the parent has a right to receive cash in the future, okay? And we will, well, not account for the right, we will account for the money because it is what we call cash in transit, and it is owned by the parent because the bank has to pay the 50 to the parent, okay? So that is why we would set up an asset, call it cash in transit, and put it on the balance sheet of the group accounts. So in the end, we have the inventory, which is sitting at the subsidiary, and we don't show an intercompany receivable, we don't show a company liability because these two were eliminated. And the difference in the elimination process was that the parent will show future cash flows coming in already on the balance sheet of the year end. So it's an asset of the group because the group has the right to get that asset. Okay. Questions? Okay. Then we can go on and look at intercompany accounts with some goods in transit. So goods in transit is the next thing. So the facts are, prior to year end, the parent shipped goods in 2 parcels to the subsidiary and recorded trade receivables of 500. So we will see at the parent's single financial statements, we will see 500 intercompany receivables. Then on 31st December, the subsidiary received only 1 parcel with an invoice of 400. So what they do, the subsidiary, they put the 400 in inventory and set up an intercompany liability of 400, because that is from the perspective of the single financial statements is what they have and what they owe. Okay. So obviously here is a difference. And what will the parents do at consolidation? Well, they first will have to add up the subtotal. So the group will show 400 inventories, the 400, which was received before year end by the subsidiary. Then they will show intercompany receivables, and they will show intercompany liabilities in this subtotal column. So we know there is no, there should not be any intercompany accounts in the group accounts. Therefore, we have to eliminate intercompany receivables by 500, showing 0 intercompany receivables. And we will eliminate those receivables against the corresponding liabilities, which is in this case only 400, because the second parcel that arrived 5 days later after the balance sheet date was in transit. And therefore, well, it's not lost in heaven, it's not lost in the sky or space or whatsoever. It will come eventually back to what was it received to the subsidiary. So the subsidiary will show goods in transit of 100. So after adding 400, which is the first parcel, and the 100 of the second parcel, the world is good again, right? We show 500 in inventory, and we don't show a company receivable, and we will not show intercompany liabilities. Okay, convinced? Good. Then we can look at the third example. What was that one? Impairment, yes. So 2 months before year end, the parent controller noticed that intercompany receivables of 800 are overdue. Maybe 50% that is her estimation will not be paid by the year end. So she recorded an impairment expense of 400 in the parent's books. So what did, and then at the year end, we will see that the parent will show 800 times 50% as an intercompany receivable. And well, in the P&L, I have added here a P&L account and marked it that this comes from the P&L, where intercompany receivable is clearly a balance sheet account. So they will show an impairment charge during that period of 400. Now in the subsidiary, they of course will show the liability of 800, because although they do not like to pay, they must pay in the end if they're not broken or bankrupt or whatsoever. So they have to show that liability of 800. And in the parents' books, we have to be cautious about the value, the recoverable amount of this receivable, and therefore we will have to be cautious and impair that receivable. So when we add up all these items, then we will find that we will show intercompany receivables of 400, and we will show intercompany liabilities of 800. So the balances are clearly different. So what happens at year end? Well, when we look at the subtotals, we will have to debit the intercompany receivables by 400, because the oops, I think that is not correct, right? I just made that this year, so let me just change it. So 190. Let's see whether I can do that online. I have to go to page 150 in my slide deck. Then I can change. I think this one will, and it's interesting, you don't see that. You don't see it. It's a receivable, and therefore I have to do a credit of 400. And I have to change that one. And the impairment charge is a minus. Okay. $800, yes. So it's a credit, and well, that is the problem. Take that away. Okay, yes. Charge. No. Well, it's a matter of presentation now. Okay, I have changed the numbers and you can see it now. So please change your slide accordingly. So we have a debit of 400, and of course yeah, I know. I see what is the problem. I have to think about this one. Just the presentation should be right. In this case, I have debited the yeah, okay, so I have to go back. Yes, let's go back and then change it as it was before. Because sorry, I got a little bit confused, but I think the presentation is right, because we would credit that intercom. No, it's not right. So please, I have to think about this table and get back to you tomorrow, because I am at the moment a little bit confused. So it should be, well, maybe there is some help in chat. It's all right, we'll wait for you. Okay, yes. I will send you this slide corrected tomorrow, because I think I wanted to show to you that in the group accounts now, and that should be the total, the subtotal, we have eliminated the receivable. So we have added the value back, but that should be a debit of 400. So in the we will show a receivable of 800 before we eliminate it, and we will show a an impairment charge of 0. So that should not be 400, should be 0. And we will have a company liability of 800, and then we can eliminate those intercompany balances. So in the end, you will show 0 as an intercompany receivable, you will show 0 as an intercompany liability, and you will reverse that impairment charge done by the parent. That will, in the group account, will be 0, because in the end, you will not have an impairment of an outside asset. The intercompany receivable is clearly a receivable within the group, and therefore you will not show that intercompany receivable, and you will not show this intercompany liability. And when you write that down during the year, you have to reverse that expense. So in the end, it should be 0. I will change that slide tomorrow. and then send it to you. All right, so my key messages are always exclude intercompany current accounts. So current group receivables are not external group items, therefore we have to eliminate. Most of the time, receivables and liabilities within the group are at the same amount, so we don't have a problem. But if they are not at the same amount, we will have a difference. So we will have to look at the difference and try to account for that. It could be cash in transit, it could be goods in transit, and it could be an impairment that has to be reversed. So cash in transit, goods in transit, and impairment charges that need to be reversed. All right, so that is what I would like to say about intercompany balances elimination. And my question, you have questions regarding this one? No, then we will look at the elimination of internal income and expenses, so-called intercompany transactions. So we looked at the intercompany accounts when we looked at receivables and liabilities. That was the balance sheet oriented look. Now we look at the income statement, and we could have also transactions there. So for instance, a subsidiary rents out rooms to the parent. The parent does not have a building, so they use the building of the subsidiary, and they have some rooms over there. And of course, they have to pay a rent to the subsidiary. So what will the subsidiary show in their single financial statements? Well, they will show a rental income. And on the other hand, the parent will show a rental expense. But when you look at the group as being one company, you would not book from department A to department B some rental expenses and rental income. So when we look at the group as if it was one company, they would not have these rental income and expenses. Or the parent charges a license fee for the use of a trademark owned by the parent to the subsidiary. So the subsidiary will pay license fees, so they will have license expense. And the parent will get those payments, and they will show a license income. Same thing as if the group was one company, they would only have a trademark, but they would not charge their sales department to be for the use of that trademark. So these examples clearly show that we have to eliminate those intercompany transactions. So here is another case study for us. Let's do it in class. So we have transactions between group companies, and that results in income and expenses that do not represent external group items. So here is the example. The subsidiary charges license fees for the use of a trademark owned by the subsidiary to the parent, and now shows a license income of 250. So here is the subsidiary that has a license income from the parent, and the license expenses are shown with the parent. But I think then shows license expense in the same amount. Okay, so obviously the subsidiary owns the trademark. Okay, so in that case, these expenses and income is right. So what we do, we just calculate the subtotal of 250. So in practice, you would also see the possibility that these will be put in one row, and then in the row they will eliminate during the adding process. But in that case, just to make it clearer, I have used 2 lines, and well, in the subtotal we show a license income from a patent that is owned by the subsidiary, and we show a license expense by the parent that is using this patent. So we have to eliminate those by, well, debiting the income. So there is no income at the end, and we have to credit the expenses. So in the end, there is no expense in the income statement of the group. I think that is clear. And or are there questions? There is one in chat. Why is it 250? Yeah, that's always the question. When do you use pluses and minuses? Yeah? And my answer is it does not matter. You can use minuses and pluses as you like, but there is one rule: you should do it consistently within one table. Otherwise, you have a problem. So in this case, I thought that when you show an income, that is a minus because it's a credit. Okay. So to easier be in a position to determine whether that is an income. So when you look at assets, that's a plus, liability is a minus, an expense is a plus because it's a debit, and an income is a minus, so it is a credit. So when you have an income that is a credit, you will debit that one to come up with the ending balance in the income statement of 0. In the exam and also in practice, when presenting these numbers, you can either use this or another method, as long as you make clear what it is. Okay. So don't get confused when I use minuses or pluses. It does not matter. It is your own creative process, so to speak. And but you have to be clear of what it means. So in this case, it is clearly an income, and that is a credit in terms when we are using the debits and credits system. All right. So what are my key messages here? Well, transactions between group companies have to be eliminated or crossed out, that's another word, as they do not result in income and expenses with external parties. So income is eliminated against the related expenses. And most of the time, there is no difference resulting from those eliminations because you would not impair expenses. Okay. So that's the easiest part in consolidation when you look at income and expenses within the group. And most of the time, you will just look at the expenses and income. So you would look at the P&L, the profit and loss statement, and just cross out those income and expenses, which are the same, most of the time, the same amounts. We have already crossed out the referring book, the intercompany accounts, so receivables and liabilities. So when these income and expenses relate to liabilities and receivables, then we have already crossed out that in the intercompany account consolidation, with the debt consolidation. We just call it debt consolidation, by the way. We should be more precise and say debt and liability consolidation, but that is too long. So we just say debt consolidation, but we mean that we will eliminate the debt against or receivables against liabilities. So why would we use two elimination steps? Because expenses and income will be there, although they are paid already at the year end. So you will find expenses and income that relate to each other, no matter whether they are paid or not. But balances, intercompany balances, are only there sitting on the balance sheet as long as they are not paid. And therefore, we look at those things in two steps, although balances and expenses, income, they relate, of course, to each other. All right, and then we will come to the last step, which is the elimination of unrealized profits, and that results to the problem or to inventory. So the big question behind the elimination of unrealized profits is, can you make a profit when selling something to yourself? So think of, I have a mouse here. This is a mouse, okay? So what is the value of this mouse? Well, let's say $5, okay? So I will now sell this mouse for $6 to me, okay? I now bought this mouse for $6. So this is my mouse now. Oops, sorry. This is my mouse, okay? What is it valued at? Well, the cost was $6, right? So in my books, I own this mouse for $6. Now I sell this mouse to myself for $7. Okay, I hope you get it. And what is the cost now for this mouse? Well, it's $7. So I made already a profit of $2 on this mouse. Okay, and I think you understand. I cannot sell something to myself and get richer. Yeah, I mean, I can do that, but that would be, I think you would just send those guys directly to prison, right? Okay, so that is the problem. So you cannot make a profit when you're selling something to yourself. But what are you doing when you, for instance, sell from the parent to a subsidiary? You sell, well, hundreds of these mices, okay? And well, the subsidiary, the buyer, will of course take the higher value, which is the book value of the seller plus the profit that the seller will show in the single financial statements. That will be the acquisition cost for the buyer. So when we are talking about unrealized profits, that is one example, because I have sold from the parent to the subsidiary something. And now the same thing is sitting in the group accounts without having changed their title to someone outside of the group. So we, from the group perspective, when we sell from one company within the group to another company within the group, we sell something, we will not realize profit, because it would be as if the company, because we look at the company as one group, would sell something to itself, and that's not possible. So we have to eliminate those unrealized profits, that's how we call it, because we will, those profits or also losses will not result from transactions with third party. So they are within the group and therefore they have to be eliminated. And I will show that also in a small example. We have a parent that sold goods to a subsidiary for 600 and assume that there is a 20% profit margin. So the book value was less than 600. So what happens? Well, the parent sold the inventory though, so the parent will not show the inventory anymore. It will be shown by the subsidiary, and that subsidiary will include the 20% profit margin of the parent. So what do the parent show? Well, they show a receivable of 600 to the subsidiary, and of course the subsidiary has a liability of 600 to the parent. So the profit for the year will be 100 because that is 20% profit margin on the 600. So the parent will show that profit margin of 100 in a single financial statements. So what did they show? Well, they showed sales of 600, which was the purchase of the subsidiary. And they had the prior inventory, which was sitting in the balance sheet, in the parent balance sheet here. So that goes into cost of goods sold. And in the end, the parent will show a profit for the year of 100. So do you think that this calculation of profit, that this presentation of profit in the parent's single financial statement is correct? So just put that in chat for me. So do you agree that this that the single financial statements are correct, or do you think they are wrong and should be corrected? So just put it in chat whether what your arguments are that this single financial statement is correct, or whether it is wrong. Okay, so one of you thinks it's wrong. Well, the parent has some inventory valued at 500. They sold it to a different company, to a subsidiary, and well, they will show sales of 600 and the cost of goods sold of 500, so they will show a profit of the year. You calculate the profit of, okay, you think the amounts are wrong, okay. I was not questioning that. So 500 times 20% is 100. So you have, when you calculate the profit from the perspective of the parent, you take what it is. So you're working within 100, as we would say. So you would have to divide 600 by 1.2, which is 500. So I think the numbers are right. Okay. So is there another observation in chat? Well, we said that you cannot show unrealized profits in the group accounts. So, but here we show a profit in the single financial statements. And well, you have to understand that this is correct. But when you look at the parent only, you look at the single financial statements of the parent, and they have sold inventory to another company. That's the legal perspective. And the legal perspective says, well, you have sold something to somebody else, so you will have to show, you are able to show sales. And of course, you have to use the inventory as cost of goods sold. So it is correct for the parent to show a profit for the year of 100, okay? But now when we come to the group accounts, okay, let's first look at the single financial statements of the subsidiary. Well, is their accounting correct? Well, yes. If they buy something at a market value or at 600, well, that is the cost for the subsidiary, and therefore they will have to show the inventory at 600 in their subsidiary, in their single financial statement. Okay, so the accounting is correct when we look at the subsidiary, at the single financial statements level. Okay, but of course for group accounts, we have to eliminate those unrealized profits, and here is how we do that. So first we will enter the inventory in the subtotal. We will add all the receivables, and we have 600. We will add all the liabilities, 600, and then we will do the same thing in the balance sheet. The profit for the year is 100. Then when we look at the income statement, sales are 600, cost of goods sold 500. So let's assume that the subsidiary did not have their own sales. So just for the simplicity of the model, so the profit for the year is 100. So we have the subtotal here, which shows inventory 600, the receivables and liabilities, and a profit of the year, and it shows some sales and so on. So what do we have to do right now? Well, any idea? Okay, so let me see. First, what do we have to do? Well, first we have to make the debt consolidation, but that was already done. So that was step, I think that was step 2. First step was equity consolidation. We got rid of the investment and the equity of the subsidiary, investment of the parent against subsidiary equity. Then we did the second step, which is the debt consolidation. We would eliminate trade interco receivables against trade intercompany liabilities. So we did that already. But just for completeness, I put that into this slide. So you will see that the 600 will be a credit. So the debit, the receivables will be added with that credit. So in the end, we will not show any receivables in the group accounts. And the same thing is 600 here, which will be a debit, and the resulting balance will be 0. So that's the first thing that we already did. Now, what else do we have to do? Well, we have to eliminate the intercompany profit. So we know that this profit relates from the sales of those inventories, and we have to take back that unrealized profit because the items are still within the group, and therefore they will not be, the profit will not be realized because the inventory was not sold outside to somebody outside of the group. So what do we have to do? Well, we have to reverse the sales, because that was only from one intercompany to another intercompany. So therefore, we would reverse the sales. So we would debit sales. We would credit cost of goods sold, because we still have that inventory sitting on the balance sheet of the group. Yes, it changed from the parent to the subsidiary, but from the group's perspective, it is still sitting in the balance sheet, and it should be sitting there at its original value. So the value that was there before that intercompany transaction, and that was 500. So we would put the difference as a credit to inventory, thus valuing the inventory of 600 minus 100 to 500. So in the end, you will eliminate the intercompany profit, and the result is that the inventory is valued at cost. Okay, and then the third thing is we will have the result, the P&L effects are also eliminated, because the profit is eliminated, the cost of goods sold is eliminated, and again here the resulting profit. So you see that in the end we only show the inventory, which of course is there. It has changed maybe the location. It went from the warehouse of the parent to the warehouse of the subsidiary, but it is still there. There are no receivables and liabilities within the group, and there is also no sales transaction, and the related cost of sold, the cost of goods sold are eliminated. And in the end, also the profit for the year is zero, because it is unrealized. The inventory is not sold to outside companies. Okay, so that is what happens in the fourth elimination process, in the fourth elimination step, where we would eliminate unrealized profits in group accounts. And most of the time, this relates to inventory. So in practice, what the companies will do, they will analyze their inventory and look at what comes from intercompanies and what comes from outside third parties. When it comes from outside third parties, then it's okay, then the cost is the purchase price. But when the inventory comes from intercompanies, other related parties, then you have to look at the profit, and that profit has to be eliminated. And most of the time, it will be done like in a lump percentage. You would just look at how much inventory is there from single companies, and then you would just eliminate the profit via one booking. You would not go to each and every purchase and then figure out what was the relevant cost of sales and then determine the profit for this single transaction. No, you would just do that on a global basis, and then just for each and every group company, you maybe determine how much profit they have, and then just delete that or eliminate that from the inventory. So there might be a lot of estimations going on. So there is, of course, a certain chance that those figures are wrong. But if they are not materially wrong, then I think the auditor will not say something, and will accept the way of eliminating the unrealized profits. But I think this small example shows you what is the problem and how that will be has to be eliminated to come up with group accounts that will not show unrealized profits from transactions within the group. All right, questions? No? I think, yeah, there was one more hint, like number 4, the profit for the year will be corrected in the balance sheet and also in the income statement. So I think we mentioned that also. Okay, so I think after the break, we will go on and prepare the booking entries for this one, because now it's 4:30 and I think we all need a break now. You might have an early dinner and I will have an early lunch now. So see you in 1 hour. So bye-bye for now.